Welcome. This is the Financial Apostle. Today I'm going to be talking about financial literacy. If you are new to this channel, don't forget to subscribe. What is financial literacy? Financial literacy is the ability to understand and effectively use financial components and skills such as budgeting, investing, borrowing, taxation, and personal financial management. Being financial literate allows an individual to be better prepared for specific financial roadblocks such as sickness, a car breaking down, there's an emergency that is arisen uh, within your family or at your workplace or anything around you. So in turn, you should be able to decrease the chances of personal economic distress. So when these financial roadblocks hit us, most of the times people are not prepared. But with good financial literacy, you will be prepared for these financial roadblocks and you will be able to handle them without any challenges. As you look at financial literacy, there's this the cash flow quadrant, which has got four quadrants. The left side is the employee and the S self-employed. On the right side, you've got the business owner and the investor. Depending on your level of financial literacy, you either fit in any one of these quadrants. Most of us are on the left side of the quadrant, is either an an employee or self-employed. And we also desire to be on the right side of this quadrant, whether you become a business owner or you are an investor. So the ideal quadrant that we all desire to be at the end of the day is to be an investor where money will be working for us. You are not working for money as in the E quadrant and the S quadrant, but you desire to have money work for you. There are components, fundamental components of financial literacy. The number one component is budgeting. So there are four main uses for money that determines a budget. Under that, we have got a spending. Within your budget, you should be able to set aside or determine the items where you are saying you are going to be spending your money, that you're going to be spending your money on food, on fuel, on electricity, on various items. So which means you are listing all those items and putting monetary values against each item. Then within, after you've listed all the items where you are going to spend your money on, you should also set aside money that you are going to be putting towards your investments, which means toward either you are going to invest in the stock market, whether you're going to invest in the money market, whether you're going to invest through mutual funds or fund management companies or unit trusts. So it depends how you are going to invest. And then you also need to put aside money for your savings. So this is all coming from what? From your income. Then you're able to divide your money into these specific categories, whether spending, investing, saving. And then also, as humans, we are bound to give to other people or to worthwhile causes or to charity. So it's good to set aside some money that you are saying, I'm going to be giving a certain amount of money every month to a certain charity, or you are donating to a certain family, or you are helping out somebody. So all these things should be kept in your budgets so that you don't get to spend without knowing where your money is going. So a budget should be composed in a way that pays off all existing debts and leaving money aside for savings and making beneficial investments. So again, where do we put in our debt payments? Which means we are putting our debt repayments under your spending. So depending on the level or amount of debt that you have, you should be saying that your goal should be to reduce your debts because every debt comes up with that interest payments. So you want to quickly pay off your debt so that you don't lose more of your money through interest payments. Number two, and the fundamental components of financial literacy, we have got investing. As I said before, the main goal from the cash flow quadrant is that we all want to be in the I quadrant where we become investors. So the journey starts here, whereby you look at the key components where you should learn how to invest. But under investing, you should know each and every where you have decided to put your money into. You should look at the interest rates. You should know how much interest you are going to be earning per month or per annum or per quarter or for half yearly. So you should look at you compare, like you shop around, because there are different places where you can put your money, or whether it is through a bank, there are different banks you move from. You make a comparison. You do like you're shopping, you're comparing, you list down the interest that is offered by bank A, B, C, D. Then you also look at the price levels to compare. Okay, yes, I'm going to put X amount, or I've got X amount of money that I want to invest. This is the bank is offering 10%. You look at, okay, the admin costs, the cost of administering or managing your fund is so much. You compare the price levels to the interest that you are going to receive from your investment. Whether is it coming quarterly or is it coming yearly, you make those comparisons. And then also under investing, you look at diversification, because as we all know, that there's this saying that don't put your eggs in one basket, which means you have to diversify. You put your eggs into different baskets, so that if one basket is not performing well, the other basket might be performing well. You might have your money put, say, in the stock market. Some of your money you put in money market. Some of your money you put in real estate, and some of your money today there's cryptocurrency. You are putting some money in cryptocurrency. Then under this also, you should have look at the risk mitigation measures. What are you doing? What are you going to do to minimize the risk? Because the risk, we cannot eliminate the risk 100%, but we can only minimize it. What measures are you putting to mitigate the risk? Are you going to take an insurance policy to cover your loss of money in a particular investment? Or your risk measures are going to be mitigated through diversification? And there's also, you can invest through indices like the S&P 500, the Dow Jones, the FTSE 100. There are different indices where you can try to invest through. And these days there's a proliferance of what I can call sugar-coated pyramid schemes, where people promise people returns. So put in, say, $1,000, and then after 24 hours, 48 hours, or 36 hours, you'll be able to get $5,000. But a warning that I can put, that say that you should study those, who is behind that, where would that money be coming from? Say, I invest $100 today, and then after 48 hours, it has grown to $1,000. You see, such type of investments, they lack the fundamental principles of investing. How does that money get to grow? So when you are investing, you should shy away from such investment that promise a ridiculous returns within a short period of time. Well-known investors like the Warren Buffetts, Charlie Munger, they made their billions over time. George Soros, we know they're investors in the stock market, but they made their money after a long time. We never read that they went into they made their money through pyramid schemes. So investing is a journey which takes time. You should not say put your money and you expect that in a few hours you are saying I invested $100, then in a 48 hours I've now have $1,000. Such schemes are, like I said, they are sugar coated pyramid schemes. So shy away from such investments if you don't want to lose your money. So by learning about these companies, you'll be able to make smart financial decisions that result in an increase in inflow of money. So money eventually comes through making smart financial decisions. Number 3, borrowing. So borrowing is something that we cannot run away from. Debts come from borrowing, but we should know when the time comes that we need to borrow money because you need to pay in to make a purchase, you need to buy a house, you need to buy a car, or any other thing that you may want to use your money for. You should look at interest rate. What is the interest rate attached to that borrowing? So this is the cost of those funds. Is it 10%? Is it 20%? Is it per annum, per month, per quarter? You should understand. Or it's flat. Because some they say 10% flat. Is it on a reducing balance? Is it compounded? So when it's compounded, say you suppose you miss an installment, then the interest that you were supposed to pay in that particular month that you have skipped, they compound it. So which means you are paying interest on interest. So you should understand all those terms that come attached to that loan that you are going to get. There's also understand the issue of time value of money. As you know that money loses value due to inflation. So a dollar today is not worth a dollar tomorrow. So you should understand the time value of money. Where are the interest rates or the inflation rates? Is it going up or is it going down? You should know that is it the right time to borrow or it's not the right time to borrow? Because you might borrow today, interest rates are said, what a particular amount says 10% per annum, and then because of the economic trends, you find that interest rates they start rising, which means the terms of your loan should set whether is it a fixed or is it a floating interest rate, so that when there is a change in interest rates, they will also change the rate of interest that they are charging. If it is fixed, you know that if they are increasing the interest, you are not going to be affected because you logged in your interest rate at a particular rate. But also locking your interest at a particular rate, you might lose out in terms of when interest rates are going down. You remain paying a higher interest rate when actual interest rates are going down. So you should understand the terms of your loan. Then you also should understand the payment period, whether you are going to be making monthly installments or whether you're making quarterly payments or half yearly or yearly. So you should also understand all those things. And also under borrowing the loan structure, you should understand all these in the terms, the repayment periods, how you're going to draw down your loan. All these should be clearly stated in the loan agreement. The structure of the loan should be clearly stated so that you are not going to be surprised when you are hit with certain penalties that will arise because you are saying you are in a breach of in a certain agreement that you would have signed without actually getting to understand it. So if you understand this sufficiently, your financial literacy will increase. You'll be able to negotiate better. You provide practical borrowing guidelines and reduce long-term financial stress. Because most people get into financial stress because they say, I didn't know that there was this clause, I didn't know there was this term in the loan agreement. Now I'm being asked to pay more than I thought I was going to pay. But when you are a financial literate person, you get to understand all the nitty-gritties that are enshrined in the loan agreement and to ask intelligent financial questions. The next one under fundamental components of financial literacy, we have got taxation. Most people they have goosebumps when we talk about taxation. But when your your level of financial literacy is high, taxes should not be a problem. you understand them. There are different forms of taxes that affect our income, whether is it employment income, investment income, rental income, or inheritance. So there are basically here I've got 4 types of tax that you pay. Either is it income tax, it's for business, then pay as you earn for employment income. There's capital gains tax. This is tax that you pay when on the sale of assets or specified stock or securities or assets. Then there's also with the withholding tax. All these taxes have got different rates. For example, income tax for companies is at 25%, plus as levy, which comes to 25.75%. And then there's also pay as you earn. The rates for pay as you earn, they range from 0 to 40%. So for example, under a company, if you are saying a company makes $100,000 as profits, they are taxed at a rate of what? 25.75%. As an individual, your annual salary, say $100,000 as well, but you'll be taxed at 40%. You see the difference? And as an individual, you get to pay more tax, yet a company pays tax at a what? At a lower rate. You see, the tax system is like it favors more corporates than individuals. Then the capital gains tax is standard rate is about is 20%. Then withholding tax is what? 30%. So the awareness of the different tax rates permits economic stability and increase financial performance through income management. So as you understand how tax affects your income, you'll be able to make better financial decisions. You'll be able to understand the economic trends and see how they impact on your tax payable. And number 5, personal financial management. The most important criteria includes an entire mix of all the components that we mentioned above. That is what? Budgeting, investing, borrowing, and taxation. So financial security is ensured by balancing the mix of financial components to solidify and increase investments and savings while reducing borrowing and debt. So as you understand all these components, you are able to manage your funds in a better way, because you know that from your budget, I'm going to put a certain amount of money into investing, and then I'm being taxed at a particular rate. And then if I need to borrow wisely. I need to know where to borrow, at what cost. And then all these, at the end of the day, you are able to reduce your debt. Because when you don't manage your money well, you end up incurring too much debt through what? Interest rates, interest that are going to accumulate when you fail to meet your installments. You end up falling into a huge debt trap that will take years for you to what? Come out of. What are the benefits of financial literacy? As you increase your financial literacy, you know that your ability to make better financial decisions increases. You have got effective management of money and debt. As we said that you know where and how to borrow, and you are also able to negotiate for better what? Terms for your loan. Then you've got greater equipped to reach your financial goals. You know that you are said that after 12 months or after 36 months, I should have set aside, say, $50,000. And you know that from your plan, you know that every month, which means I should be setting an X amount of money so that after 36 months, I have my $50,000 in my investment. Then we also have the reduction of expenses through better regulation, which means we are able to regulate yourself. You are able to spend wisely. You might still be getting the same type of goods and services, but at a cheaper rate, because now you have got the knowledge and the know-how to compare and negotiate with your service providers or with your suppliers of your goods. Then you see that financial stress and anxiety reduces because you make decisions in an informed position. Then there's also increase in ethical decision making when selecting whether is it insurance, policy, loans, investments, or you're going to use your credit card, or you're going to have an overdraft facility. When you go into these things, you go in with the right questions, with the right mindset, and know where to go because you have done your homework, you have done a shopping around, and you have made your comparisons, and you are now understanding all the terms and conditions that come with each investment or with each loan that you need to get. So there's another benefit is what effective creation of a structured budget. As we said that your budget, you put in your expenses, you put in your investment column, you put in your savings column, and then you put in your giveaway column, and then we have those a balanced position in your budget. Then we move on to strategies to improve financial literacy skills. So strategy number one is you create a budget. So a budget is a critical tool that you need to embrace and understand so that you improve your financial literacy. So your budget should also tell you, should be to capture how much money you are receiving, whether is it through your salary or any investment, or is it in a donation. But all the money that you receive, you should be able to put it down. Either you're using an Excel sheet, or you're writing in a paper or in a book, or you're using a budget app, which means all your incomes should be able to note them down so that you know how much money you are receiving. Is it per month? Is it per annum? And then also you should be able to know your expenses and list them as well, which means on a daily basis you have a habit of noting down, capturing all your expenses so that you will not be surprised to say, I can't remember how I used whether my $100, my $50. You're wondering. You think maybe you've lost money, but it's just that because you skipped recording, then you end up not knowing how you spent your money. The second thing that you should do under strategies to improve your financial literacy skills is you must pay yourself first. Most of us, we pay ourselves last, if ever at all we pay ourselves. So for every income that you receive, you decide to say, if you are saying 1% is you are paying yourself, which means do that 1%, 5%, 10%. Your salary, receiving a salary is not like you are not paying yourself. Pay, because from your salary you are going to pay bills, you are going to buy fuel, you are going to buy airtime, but at the end of the day, which means that man is going to other people, it's not coming to you. So you should develop a habit of paying yourself first before you pay anyone else, because if you put yourself last, what happens is by the time you get to the last item on your list of payments, money will be gone. You won't be having any money to use. That's why people end up going to borrow, because there is still the list. There will be still some outstanding item that needs to be paid, and then they resort to borrowing to cover those gaps. So you rather pay yourself first, and then what do you do with that money that you pay yourself first? It is the money that you can use to put your investments or your savings account. And then number 3, you should pay your bills promptly. Paying your bills promptly helps in what you avoid incurring extra charges for late payments, whether it's a late payment fee or it's an interest that is charged for paying your bills late. You avoid that by paying your bills promptly. You should not do the dates when the bill is due. Suppose if there's a grace period of say of 7 days, you might choose to pay on the very last day, and then through probably some money that you might have invested somewhere, then you're saying, okay, I'm getting if I pay by the last day, which means I would have received, say, 5 days interest from a certain investment that you say, I'm going to put on a call in a call account, which means a call account is an account that you say anytime you can call those funds, but by the time you call them, they would have accrued some interest. You have some interest that you have received. So instead of putting your money under a pillow or you keep it in a wallet, you can put the money in a call account and then take it as when there's a bill, the bill that you need to pay is due. So the next strategy um, is get your credit report. How does your credit report help you? Because whenever you want to go and borrow or you want to get a mortgage, the financiers, they want to know your credit report. So you don't need to be surprised when you are told by this financial institution or mortgage provider or loan provider that we are not able to give you a loan or a mortgage. They will not tell you the reason, but most of the times it's because your credit report will be bad. Does it get bad? Because the more you don't pay your bills on time, the more you borrow and fail to pay, that those financiers or loan providers, they send that information to credit bureaus like TransUnion, and then they capture that information. So next time you are going to another financial institution or loan provider, you apply for a loan, they do all those checks and they find that you are a high risk client. So they will not what? They will not give you that loan. And also you should check your credit score. So because for anyone to qualify for a loan, there's a certain there's a certain score that they should achieve. And that score is affected by how well you service your loans, how well you pay your bills. So if you are recorded as somebody who is slow in paying, who is also you only pays when they receive a call uh, for payments, then you are creating a what? A bad credit score and a credit report for your name. Then the next thing under strategies to improve financial literacy skills, you need to manage debt. So you use your budget to stay on top of debt by reducing spending and increasing repayments. So if you are somebody who is having a challenge of your debt accumulation, which means you should go back to your budget and look at how you have been spending your money and look at areas where you can reduce your expenses and and channel those savings to reducing your debt, which means if you rather increase the amount of money or installment that you pay, if you have got a loan that has got a high interest, by quickly paying more than the minimum, which means you are increasing the amount of money that you are paying, it means that loan is reducing at a faster rate. So it's very important that you manage your debt, use your budget to manage your debt. And then you can also use methods like debt avalanche method, or you use the snowball method, or use the debt consolidation method, which means this time you can sit down with your financial advisor, or you should sit down with your partner or your spouse and look at ways you can try to quickly come out of debt, so that at least you have time to channel your incomes to savings. Because as you all know, everyone as a new day is coming, that we are aging towards retirement. So it's important that you have money that you set aside for what? For your future. So the last strategy that you should use is invest in your future. By investing in your future, which means you are putting money aside that will meet us at our old age. You might be 20 in your 20s, in your 30s, but when you are investing, which means you are investing for funds you are investing into your future. Say by the time you get to say 70, 65 or your retirement age, you should have some money that will be waiting for you to be used by you when you retire. So when you're working, suppose you're working for a company, you should check whether there is a pension scheme that your employer is offering. Then be part of that scheme. Usually, when companies that offer pension schemes, which means you contribute 50% of the monthly contribution, and the company puts in the equal amount, say 50%. Say if they say 5% of your basic, they take 5% from your basic, says 5% of $100 is $5. Then the company also put $5, which means the amount that goes into your pension is $10 on a monthly basis. So you should take advantage of such schemes where the employer matches your contributions. Suppose your employer does not have such facility, you can also arrange to have your individual retirement account through insurance companies. They offer that, and then we are also contributing money for your retirement. So as we said again, by investing in other investment vehicles like the stock market, through bonds or mutual funds or unit trusts, you are saying this money, you are saying you are going to use it through in your future. You are not using it immediately, but you are putting something that will be able to look after you after you are no longer in active income. But remember, as I said, if you go back to our cash flow quadrant, when you are in the I quadrant, which means you'll be able to live off your passive income. You have bought some real estate, you are receiving passive income through rentals. Every month there is money that is coming through. Or if you've put in money in a money market account, you choose to say, I'm only going to be withdrawing by interest, and then I'm leaving my principal to continue earning me interest, which means all those things, which means you are investing in your future, so that when future we are no longer able to work, your money will be looking after you, and you are no longer looking for money. Let's hear your comments. We would like to hear your comments in the comment section. We will meet you in our next video. You can find us through these other channels. Thank you.